Welcome back to the channel. This video is about my asset allocation and the reasons behind it. I'm going to try to keep it as brief as possible just to give you an overview of it, and you can explore more about it as you see fit and if you're interested. Otherwise, I'm just going to keep talking forever, and that's not going to help anybody. So let's jump right into it. So my asset allocation is basically 50% in large cap growth, 25% in long-term treasuries, 15% in gold, and 10% in REIT. Now, when you're looking at that, you can think of the REIT almost like another asset of equities, of stocks. So essentially, it's a 60% stock portfolio, 25% long-term bonds, and 15% other. Right? So very similar to like a 60-40 allocation, but some of these specific assets that I chose for these classes are a little bit aggressive. So for my large cap growth, just as an example, I choose the NASDAQ 100. And then for my REIT, instead of using like a ETF or something like that, I chose Realty Income Corp. And I'll get into some of the reasoning for that. But before we go into the why of that particular asset allocation, let's look at how I came up with it, and then we can talk about more of the reasons. So on the computer here, we are using one of my favorite tools. It's available for free. You can certainly subscribe if you think it's valuable to you. I encourage you to do it just to support the developer. But for me, the free version is more than adequate. What I'm going to do here is I'm going to compare a couple of portfolio asset class allocation, and we'll see how they perform over the long run. So down here you can see that there are three portfolios, portfolio 1, 2, and 3. The first one is just 100% US stock market. I'm not going to get into the discussion of whether you should use some non-US or international equities, emerging markets, all of that. For my purpose, because I'm based in the US, this is fine to use 100% US stocks. So this is basically just 100% stocks. Portfolio 2 is a portfolio that's popularized by a man named Tyler, who runs a site called portfoliocharts.com. He calls this the golden butterfly. It has 5 asset classes. It's split evenly into the 5 asset classes, and the classes are US stock market, US small cap value, long-term treasury, short-term treasury, and then gold. He calls this one the golden butterfly, and it's modeled after a portfolio allocation that was popularized even earlier by a gentleman named Browne. That's called the permanent portfolio. The main difference is that the permanent portfolio only has 4 asset classes, and it's very similar to this, but slightly different. It's 25% allocation to each class, and that seemed to work too. But the golden butterfly by Tyler over at portfoliocharts.com is based off of that, so it's very similar, and it's equal weight to the 5 asset class. And then there's another gentleman that has a popular podcast that's called Risk Parity Radio. His name's Frank Vasquez. He's popular within kind of the investing geek world, I guess. Maybe not as large, although he has quite a big following. And I like the podcast. I listen to it all the time. I encourage you to listen to if you're interested. And he did a take that is similar to Tyler's golden butterfly, except he calls it golden ratio. And in his golden ratio, he's got 42% stocks split into all stocks, small cap value, and whatever. So I try to replicate it as best I can using here. It's probably not exact, but it's close enough for our purposes. But he calls it the golden ratio portfolio. And if you ignore the details and add up the stocks, so if we add up large cap, small cap value, and total stock markets, 42%, and then we have 26% in long-term treasury. He's got 6% in money market, which I will assume is similar to short-term treasury. He's got a gold component that's a little less, 16%, and then he's got 10% in REIT. Okay, so these are the 3 portfolios that we'll compare. If I analyze these portfolio, I'll get a back test that is almost 30 years. It's from 1994 to 2023. So here are the allocations of the three portfolios. So again, 100% stocks in portfolio 1. Tyler's Golden Butterfly is portfolio 2. It's evenly split, 20% each in each of the 5 asset classes. And then Frank Vasquez Golden Ratio portfolio, which again is similar to this, except just allocated slightly different using the golden ratio from mathematics. Once we go and run the analysis, we get some interesting statistics down here in performance summary. And the important thing to note here are the compounded annual return. This is a CAGR, so compounded annual growth rate of the different allocation. Of course, 100% stocks is going to give you almost 9.9%, almost 10% over this 30-year time frame. Although Tyler's Golden Butterfly isn't too shabby at 7.5%. Frank improves on that with a golden ratio at 8.27. So they're in the same neighborhood. What I want to draw your eyes to, though, is this column right here that's called the standard deviation. This is a substitute for risk. It's not exactly risk, but it's a good measure of it. It's basically the volatility of the portfolio over time. And clearly, 100% stock is the most volatile at 15.5 with the standard deviation. But Tyler and Frank's portfolio are a lot less volatile. And you may wonder, well, what does that mean for me in reality? If we go a little bit over to the right here, there's another column that's called max drawdown. And if you read what max drawdown means, and I'll go into it a little bit in a second, but max drawdown is basically how much your portfolio will drop from the very top to the very bottom over any given time frame. And as expected, the max drawdown for 100% stock is very high. It's almost 51%, which basically means that from the peak to the trough, from a high to a low, your portfolio value can go down 51%. But if you look at the Golden Butterfly or the Golden Ratio portfolio, the max drawdown is significantly less, right? With the Golden Butterfly, it's down 17.5% at its maximum. And for Frank's Golden Ratio portfolio, it's down 24.5% at its maximum. And this is over 30 years. If you're doing a back test like this, the longer the data that's available for you, the better, right? Let's dig into the max drawdown just a little bit more. You can see when it happens and why it's important. If I scroll to the top here and go down to drawdown, so there are tabs here, this illustrates what we're seeing. So portfolio 1, 100% stocks. You can see that the 51% drop was during the Great Recession. So you're humming along and all of a sudden your portfolio drops. And from the time that it drops to the time it recovers is how long the drawdown lasts, right? If we were to go down here and take a look, for portfolio 1, the max drawdown has a length of only 1.5 years, almost 1.5 years. But you were underwater for almost 4.5 years. This is how long it took you to get back to essentially zero. If you were relying on these funds, you're underwater for almost 5 years. That's scary. You know, there are other time periods where the underwater period is even longer. This is 5 years and 8 months, almost 6 years of being underwater. If you're retired or relying on these funds, it can be very scary to be underwater for that long period of time. And even if you're not retired and you're accumulating assets and wealth, drawdowns are important because if you are just always in the negative, it can be quite discouraging. That's a psychological factor because if you are accumulating wealth, you actually want the market to be dropping and continue to drop at the time that you're contributing and buying more assets, right? Because you're just accumulating more assets cheap. But psychologically, it could be quite discouraging. and can stop people from keeping at their investment plan. So that's why drawdowns is important even if you're not retired. If we scroll down to portfolio 2, this is the drawdown portfolio 2, the golden butterfly, you can see that even at the worst, you're underwater for just less than 2 years. That's significantly better than being underwater for almost 5 years. This happens to be the same time period. This is the Great Recession, and you can see the performance of the golden butterfly for drawdowns. Looking at Frank Vasquez's golden ratio portfolio, it shows the same statistics, or characteristics, I should say. The drawdown is significantly less than being in 100% stocks. That's that volatility that we're talking about. And that alone can keep you investing with a plan. So I show you this because I started with all of these research done by other people and then forming my own. So going back to my allocation, which is this tab here, I specifically chose this because this mimics a lot of what the golden butterfly and what the golden ratio portfolio does, as well as other risk parity style or risk parity inspired portfolios. So I chose these very specifically for these allocations, so there'll be some similarities. Where I differ is that for certain asset classes, like this one, which is large cap growth, I decided to pick the NASDAQ 100, which is quite aggressive, but I have my reasons for that, and I'll go into it when we see the results. And then for my REIT, instead of picking like a basket of REITs, I picked Realty Income Corp. It's a REIT that owns triple net commercial property that they lease to typically single tenants. They're based out of San Diego. They own property that they lease to things like CVS and Lowe's and Home Depot and whatever. But usually large single tenant on long-term leases where the tenant's paying for basically all the upkeep and expense of the building. That's their model. So they don't own things like malls or anything like that necessarily. And I picked them again because I want to be a little bit more aggressive with those allocations. But then for long-term treasuries and gold, I kept them where they are. So this is my portfolio allocation. And then for the other two, I'm comparing it to just a straight up 80-20 stocks to bond portfolio and then the classic 60-40 just to see how it compares. 60-40 is actually pretty good for most people, not just people in retirement. But over the long term, 60-40 is kind of the sweet spot, and that's why you hear it cited quite a bit. I put 80-20 in here just because it's slightly more aggressive for people who want to take on additional risk. But let's see how these allocations perform over the long term. So scrolling down to the results here, you can see that the analysis period is not quite the 30 years. This is more almost 20 years. And the reason is that the gold vehicle that we're using to invest in gold has only been around since the end of 2004. But if you were to test by asset classes, it's going to come pretty close. And in fact, let me go ahead and do that on the asset class allocation. So we'll leave the golden ratio and the golden butterfly alone, but let's change this to what I have, which would be 50% in large cap growth, 25% in long-term treasury, 15% in gold, and 10% in REIT. If I were to reanalyze this, so this is my allocation in 1, 2 is golden butterfly, and 3 is golden ratio. You can see that my compounded annual growth rate is higher than all of them, but it is more volatile. But not too volatile compared to like, say, 100% stocks, which we remember was like 15.5% on the standard deviation. And it has similar effects on drawdown compared to, say, golden ratio. So for me, this particular allocation at the asset class level is worth it. It's a little bit more on the drawdown than Frank's portfolio, but it's still within acceptable means for me. And it's still a lot less than 100% stocks. So that's why I took it, I think, the the risk-reward trade-off for this allocation is worth it. And then when I went to select individual specific assets to represent large cap growth or REIT, I tweaked it even more by picking the NASDAQ 100 and Realty Income Corp. Okay, so that's how it came about. But let's see how it compares on the results. So over almost 20 years, the compounded annual growth rate for my allocation using the specific assets that I selected has returned 11.4%. And the standard deviation is slightly higher than just the straightforward asset classes of 10.23, but it's not ridiculously higher, right? 11.35 is not that much higher than 10.23. Drawdowns is actually pretty good. 2675 compared to 28 or something. So again, to me, that's acceptable. When we compare these stats to a 60-40 or an 80-20 portfolio, the returns blows those two allocations out of the water. But the standard deviation is also way better than, say, 80-20. Not quite as good as 60-40, but pretty close. But when you go down to max drawdowns, it does better than the other two allocations as well. So in summary, this is why I chose the allocation that I chose. Some people will say, are you sure you want 25% long-term treasury and only 50% of the large cap growth? Why? Well, why is that over the long term, this allocation actually does very well for the risk that you're taking on. 2022 was one of those odd years, but even with 2022, including the results, it still outshines a lot of other asset allocation. So should you bump these numbers up? You can, and in fact, we can go ahead and play with that experiment just to show you what would happen. So let's say that you feel that these asset weightings are a little bit too conservative. So maybe you want to bump the NASDAQ 100 up to 60% in this one, and maybe take 5% off of long-term treasuries and another 5% off the gold. Okay, and then in this one, we'll bump this all the way up to, call it 65%. We'll take this down to 20, 10, and 5. Okay. So now we've made 2 a little bit more aggressive than my original allocation, and we made 3 even more aggressive than that. If we were to analyze this, same time period, but we can see that drawdowns are just going up for every increment that we increase the NASDAQ 100, the large cap growth, as well as standard deviation. But the compounded annual growth rate isn't changing by a commensurate amount, in my opinion. Now, people can come to different conclusions on this, but for me, I think the sweet spot is my original allocation. You can always try to juice returns, but you're going to give up something. You're going to take on a little bit more risk, or you're going to have to accept larger maximum drawdowns, right? But it's up to you. I think these 4 asset classes actually work really well, and you can either stick with my original allocation or you can tweak it to your heart's content. But I found for me, this is kind of the sweet spot for almost all long time periods, and that's what I'm sticking with. So those are the reasons as to why I designed my portfolio the way I did. It's based on a lot of other people's work, for sure, but it works for me, and I'm happy with it. And I'm hoping that now that I've talked at length about it, you gain a little bit more understanding why I allocated my $1 million portfolio to this allocation. All right, thanks for watching, and I'll catch you on the next one. Bye.